Should the Tatas, the Birlas, the Ambanis, the Adanis be given licenses to start banks? What if they lend to their unit subsidiary companies and those companies don't do well and the banks get into trouble? That is the question that has been haunting people, and that is the question analysts and economists have been debating for the last week or so. Hi, and welcome to Economics. We will take this topic up today and debate why economists seem to be so unanimous about opposing the entry of corporates into the banking sector or corporates being given licenses to start banks. My name is YP Rajesh, and I'm the managing editor at The Print. But before we go dive into the topic, I want to make an appeal to all of you. At The Print, we have been trying to bring you good journalism, non-hyphenated journalism, which is not left, which is not right, for the last 3 years and some months. But this is only possible with subscriptions, with people who read us, who watch our videos, pay for what they read and watch. Because as you know, the economy has been going through a deep slump, advertising has dried up, and there is no other way media houses, and especially young companies like The Print, can fund themselves. So please do subscribe to The Print. Many of you have already done so, and we are very, very thankful for that. For those of you who have not, please visit theprint.in/subscribe and take subscriptions. If you're in India, if you're abroad, it doesn't matter. You can pay through various options there, banking and credit cards. So I would request all of you to do that as soon as possible if you have still not done so. Now let me welcome Ela Patnaik, Professor Ela Patnaik. Hi, Ela.
Right.
This is a topic that has been debated for the last week or 10 days since the working group of the Reserve Bank of India recommended that it should consider giving banking licenses to corporates. And there is unanimity. I've never seen economists agreeing on something so unanimously that this is a bad idea. What brings such unanimity, Ela?
So banks lend to firms, and nobody, not the depositors, don't pretty really know who they're lending to. And when you have a bank owned by a corporate, then it has been seen that there is connected lending. That is, they lend to their connected companies, to the companies that their promoters own. It's not just been seen in India way back in the 60s and 70s, but everywhere in the world. And this connected lending happens despite all kinds of regulatory and supervisory oversight, even in countries where the supervisory oversight is much, much better than ours. Somehow banks and their owners, they find loopholes in the system and they find ways to lend, which is why in most countries, corporates owning banks is banned. It's pretty much a no. Now, this idea in India is particularly bad because here we know that we don't have very strong regulatory and supervisory capacity. I mean, I don't know, I think, YP, we've discussed this in many of our earlier episodes. Every time that there is a crisis, we have talked about how, whether it was the Nirav Modi case, whether it was the Yes Bank case, we have talked about how RBI's supervisory capacity is weak. We've gone into why it is weak, what needs to be done. But those problems haven't been solved yet. And then suddenly we see this idea, that corporates should be allowed to own banks. And this is a very risky, very dangerous idea, particularly in a situation where it's very clear that the regulatory capacity in the country, the supervisory capacity of the Reserve Bank of India, is not up to the mark. So there is a fear that connected lending will happen, that if that lending is very risky, then those firms will go bankrupt. And with that, the banks could go bankrupt. And ultimately, the taxpayer has to pay. Whether the taxpayer pays directly, whether the taxpayer pays in our system, it's usually a public sector bank which ends up buying the failed bank. And the borrower pretty much disappears with the money. And then the public sector bank which buys it ultimately gets capital from the government or from taxpayer money. So it's a very bad idea, and all economists, even those who might have thought that under certain conditions it is something that could be done, even those economists would say that in the present environment, the Reserve Bank of India uh, does not have the supervisory capacity to properly have oversight over related banking and to be able to monitor that in case it happens, which it inevitably will, if this was to go through.
Before we go ahead, I must just tell our viewers that, when I said whether the Tatas, Birlas, Ambanis, and Adanis should get licenses, that was a very hypothetical, statement I made. None of them have applied for licenses, and none of them are getting licenses. So it was just a very provocative question from my side. Be that as it may, Ila, what what do you think prompted this working group to come up with this suggestion at this point in time, especially when our banking problems have just only piled up over the years?
See, the government has put in capital into quite a few public sector banks. So the last 2 lakh crore that was spent for recapitalizing banks hasn't increased lending much. In fact, it's pretty much gone to make up for the hole that was created after the first Feb 12 circular, when there were, 16 big large loans that had gone bad. And so it's disappeared into a black hole, if I may say so. And public sector banks are not lending today. First, of course, is the question of not having capital, and the second is that should they take risks, because even borrowers are not very healthy, and so for these banks to take risks, it is difficult. Third, the agencies and the kind of oversight they get from the C's, the various C's, all the CAG, the CWC, the CBI, also makes them very wary of giving loans in an environment where giving loans is very risky. Now, given that, how are you going to get how are you going to get growth in credit? So that's the question. And in some ways, I think this is a trial balloon, that it's an idea that has been floated. It's not that the government has said that we will do this. It is like a recommendation of a working group where, in fact, most of the experts say it should not be done, and still somehow, this recommendation comes through. And then after that, wait and see what people say about it. And I think that after this unanimous uh, criticism of this idea, at least at this particular point of time, it is unlikely, at least I hope it is unlikely, that it will go through.
Mhm. Ila, in your column we have published this morning, I request all our viewers to read it. It will be in the description of this video after the video is on YouTube. Uh, you have said that the current framework is not sufficient. Can you elaborate a little bit on that current framework, Ila?
So one part of mm, what a banking regulator does is gives out bank licenses to those who are fit and proper. The second part of what the regulator does is that it monitors the balance sheet of the bank. So it looks at what are the loans that are being given. Now, in that, it is good if we had another agency like what was proposed in the FRDI bill, and that was there, the resolution authority, which could also have oversight over bank lending books, so that it could see whether the loans that are being given are going to healthy institutions or not, will they become bad loans or not. Because ultimately, if the bank goes towards failure, then you need somebody to have an orderly resolution mechanism, and that is what was proposed. Now, basically the point my co-author Radhika Pandey and I are making in this is that since we did not go through with the FRDI bill, and since we do not have a parallel supervisory capacity, and since we do not yet have an orderly mechanism through which if a bank fails, then it doesn't fall on the taxpayer. So this framework is today not good enough to take on this risk of giving corporates bank licenses.
The other point you made, Ila, when we discussed this a couple of days back, uh, and this is my last question before we take questions from our viewers. So please do send in your questions. You can send it on Facebook, WhatsApp, Twitter. The point we discussed, Ila, was corporate governance. That corporate governance standards in India are not still good enough. Why do you say that?
See, if you look at some of the private banks, then also there has been trouble. One could have argued, and many people have argued, and I've also argued earlier that in public sector banks there is political pressure. The government owns these banks. The government does what is called phone banking. Mocking not in a non-serious way, that politicians make phone calls and public sector banks have to give out those loans. So even if all that is true, then the story is that public sector banks make bad decisions, right? Now, I think what we're saying here is that it's not just public sector banks. I mean, if you look at some of the recent bank failures or the difficulties that banks have had, it is because of the failure of corporate governance in private sector banks, because the board hasn't done its job of making sure that the bank does not give risky loans and hasn't looked at the bank the both the board as well as whatever their risk committee has been, in addition to the regulator, has missed out on difficulties and irregularities in the case of Yes Bank, ICICI, Lakshmi Vilas, and these are things that uh, one could have argued that in a country where there was very strong corporate governance, maybe the board could have done better. And so here, the point really is that it's not just public sector banks that have got bad loans on their books. It is also private sector banks, and we are in a situation of weak corporate governance. In fact, we see that in the non-banking sector, non-financial sector as well, but certainly in the financial sector. We've seen that in the NBFC sector. We've seen that in some of the large NBFCs who are still in trouble and are the, trying to be resolved. And we don't find evidence of very strong corporate governance, certainly not in the financial sector.
Okay, I have another question which just came up as we were discussing this, Ila. I mean, so many of the problems or fears you mentioned are already existing in some public sector banks. And, we have complained about the quality of governance at our public sector banks. So how much worse can, corporate banks be?
I think it's not about how much worse it can be. I would say that when the returns are private and the risks are public, then you do want to limit those risks. If I may elaborate, when when a private company owns a bank, then the returns or the profits are going to the private company. But if the bank fails, then inevitably the loss goes to the taxpayer. In case there is a corporate owner of a bank, and it is just inevitable that when there are very risky projects which are not able to raise money, then if you own a bank, you somehow find a way to get money to that bank. So riskier projects get more money, and that risk in this system is public. By saying that public owns the risk, I again go back to the point of there is no proper resolution mechanism. There is RBI does do resolution, but sometimes it is SBI buying a bank or putting money in. It's even LIC putting money in. It is Punjab National Bank that buys up Global Trust Bank. So in many conditions, many situations, it is public sector banks. I think in Lakshmi Vilas Bank, it is a different situation where a foreign bank has bought up the bank. But in the past, if we look back, a lot of it has been public sector banks absorbing the loss, which ultimately is the taxpayer who will recapitalize that public sector bank and absorb the loss. That is why I think we need to be even more careful than than the case of public sector banks, which the risk is public, but the returns are also public. The government earns the profits.
Okay, Ila, we are getting a lot of questions already, and we should not make our viewers wait. I'll take the first one, which we got from Twitter from Mandar Kagade. Mandar is a principal at Black Dot Public Policy Advisors, and he's a regular reader and viewer and follower of the print. Thank you, Mandar, if you're watching us. Mandar is asking us, Ila, that the view about fixing supervision before letting corporates in is positive, but not positive enough. Regulation and supervision happen in flux. We have to walk and chew gum at the same time. What do you think?
I think there's no getting away from the fact that India is a country that should have had a resolution authority right when we introduced private bank licensing, or at least after 91. Uh, w- why should we be waiting for so long? I mean, yes, we should have done it by now while we were giving licenses. We've still not done it. But at least now, before going ahead and saying we'll give licenses to corporates, which is far more risky than what we have done so far, I would say I don't think we should be doing that together. I think we should first pass the FRDI bill,
Mhm.
start setting up a resolution authority. It will take us a couple of years, but we should give it supervisory powers as well, even before the bank is in trouble. So, the present the present bill that has been proposed says that the FRDI, or the resolution authority, will have supervisory capacity only when the RBI says that now the bank is in trouble, so you can step in. But one of the amendments that we've been arguing for is that it should have it even earlier. So the FDIC, for example, has it even earlier, so that before you see that the bank is weak, you step in. Not that you RBI might wait before it's too late. It may be too late, and the RBI might say you step in now. So no, I think it is a precondition.
The next one is from Parimal. He's a loyal follower, Ila. Thank you, Parimal. Uh, Parimal asks, ma'am, is it possible for an auditor or a regulator to find out potential frauds if the bank has no intention of disclosing its error to auditors? Say, like what happened in the PMC bank case.
See, it is always what shall I say, a chase between the two. A supervisor is usually lagging behind and doesn't know what happens. And yet, you see, in banking, there is no other choice. We do need somebody to be looking into the books. What some of the other regulators do, in the West particularly, is that they hire people who have worked in banks. Who know the various loopholes that banks use. So instead of having a permanent sort of staff that goes in after an entrance exam and then stays there, I think RBI is also veering towards that you need people who've actually worked in those banks, who've actually figured out the loopholes, and who figure out how to fool the regulator, how to fool the supervisor. And you hire them and you use them. So this is a game that continues between supervisors, regulated entities, and the regulator everywhere in the world. And usually, of course, the regulator is one step behind the bank, but then it's always trying to go ahead and catch the bank.
Mhm. Bhargav Desai has an interesting question. Bhargav asks, is it good if corporates are allowed to give loans to only retailers, like home loans, vehicle loans, education loans? So basically, the NBFC model. What if corporates are allowed to become NBFCs?
They're already doing that.
Mhm.
They're already doing that, and they're already giving loans for various, so whether it is Sriram Finance or a lot of the
Bajaj.
Bajaj, or so, a lot of them are already in that business. So that they don't need a bank license for that. Let me just point out what the difference between a bank and an NBFC is, and why it's critical to remember that difference for this issue. A bank takes deposits. Okay, a deposit from the public at large, whom it promises to pay back. An NBFC borrows. It can borrow either from a bank, or it can raise money from the money market, or it can take on debt, it can float paper. But when you are talking about NBFCs, I don't think that's the discussion today. The discussion is that should they be allowed to raise deposits from the public, because there is a promise to pay, and there's also this whole politics around it, where you don't allow a large bank to fail. You either have a deposit insurance, a resolution authority, you sell it off. You don't just shut down a large bank. So the point here is that yes, they can have NBFCs and they can give out these loans, but as long as they're not raising money from the public, the risk is lower if they are doing just the NBFCs.
In fact, I want to also tell our viewers that a couple of days back, we published a very interesting article by our banking reporter in Mumbai, Monojit Saha. He wrote about why NBFCs don't want to become banks. In fact, that is another recommendation from the working group of the RBI, which said that NBFCs with certain benchmarks should be allowed to become banks. But this license on tap for banks, for NBFCs to become banks, has already existed for the last 4 years. But only one NBFC has applied for a bank, because the rules for banking, the requirements for banking are much, much more stringent than for being an NBFC. So we will share that article after this conversation in the description of this Facebook Live. I'm sorry, YouTube Live. Apologies. Uh, Hitesh Nautiyal, Ila says, my question is, the condition of our banking system is really serious. According to you, what are the appropriate steps that our government should take to address this?
So this is a big question, and there have been umpteen number of reports on the various steps that need to be taken for improving the banking system in the country. These include things, questions about ownership, about regulation, about the powers of the regulator, about corporate governance, about HR practices. We'll need a far more detailed and long question hour for that. But it's not a simple problem. It's not something that can be solved very easily. We've taken a long time to create all these troubles, but over and above that, I think the most important thing to remember is that banking sector itself is actually a very risky sector. You take deposits from somebody, and then you lend out to someone else. You make decisions on whether that will work or not. You're taking a risk. The risk it's risky because either the project will fail, the macroeconomy could fail, the guy could run away with the money. There are many risks in banking. So I think the two put together, it's not an easy solution, but there are a number of recommendations that have been made, and we can study those.
Thanks, Hitesh. Dinesh Singh is asking something you mentioned in our initial conversation, Eli, saying, do you think the government deliberately leaked snippets of this report to gauge the reaction from people in general?
See, typically when governments are trying something very new, then they do float ideas and, as we call it, a trial balloon, just to see
Hmm.
whether it'll be shot down or whether, people will support it. Now, in this particular case, I don't know. I'm not privy to what is happening inside the government, but I was just saying that I hope that this is a trial balloon only and that this is not a recommendation that they are going to go through because we are totally unprepared for it.
We have another regular viewer with us, Ela, his Garvit Gilhotra. Thank you, Garvit. Should new techniques like account aggregator and data-based models be used at a large scale to decrease the risk of NPAs, which is the main problem?
See, Karvit, I again would say that it's not just, yes, of course, we should technology to the hilt. But I think there's also a lot of other things. And so if you would like to go through the details of this and read the Financial Sector Legislative Reforms Commission report, read the first volume of the report. And it discusses some of the issues that we have in terms of the structure of regulation and the regulatory capacity, including on banking and what and how we need to improve it. So yes, technology should always be used, and the latest technology should be part of our path ahead in improving regulatory governance, in improving regulation. But regulatory governance is another issue that one has to address and think through. And I'll again, say that it's a very detailed thing, and we'll be happy to talk about it, but perhaps not go into the details of it at the moment.
Bhavin Patel has a tough question. Why are people so against private players in India when the government entities are so inefficient? People in the US or UK never protested when private players grew in those countries. Isn't it a double standard in India?
I think we were also very happy we adopted ICICI, HDFC, Axis Bank, many of the other banks. It is not that we rejected private players. If you look at a lot of retail banking, it moved to the banks that offered better services compared to public sector banks, where, and some of the public sector banks did improve their services as well when they were in competition. I think today's issue is not private banks. It's not about private banking. It is about the ownership of corporates having banks. And that is not an issue that the rest of the world welcomes with open arms. It's not just India, but others as well, where this is a problem. And the problem is because of the higher probability of lending to connected entities and their own companies. And I don't think that uh, we should mix it up with private as such. We could very much have far more private banks and players, but not corporates who could lend to connected companies, exploiting the weaknesses in our regulatory system.
Mhm. Ishank Sagar has a question and a sort of a suggestion. Don't you think instead of outrightly dismissing the very idea, RBI should bring in rules, make promoters directly responsible for the performance of banks they start so that the risks can be prevented?
Yes, RBI should do a lot and it should improve its regulation and supervision. I would like to begin this, I'd like RBI to begin this process by punishing some of the people and holding them accountable. Let me not use the word punishing, but at least holding people accountable for what happened in some of the earlier gaps in supervision. If I may be generous, let's
Mhm.
call this gap. So, when the core banking system of the Punjab National Bank was not speaking to the SWIFT system, which RBI was aware of from 2011 onwards, Nirav Modi could still get away with this. And I have not seen anybody maybe it's not public, but at least it hasn't been made public about who are the people who have been held accountable for this sort of negligence. And not just, I mean, I'm just giving one instance, but I'm saying that for improving supervisory capacity, you have to have many things in place, including holding people accountable. I think even if we go back to the old scams, Harshad Mehta scams, today we've still not fixed accountability of scams that happened even 20 years ago inside RBI, and who were the RBI officials who were responsible. So, I mean, I don't say that we should go on a witch hunt, but I think
Mhm.
there is a lot that needs to be done, which is why at least the argument we are making is that not just is it RBI that should fix its own supervisory capacity, you should also have a parallel supervisory capacity with checks and balances by the resolution authority, go back to the FRDI bill, and it's the job of parliament to pass that. So parliament has a role, RBI has a role, and together we can make the capacity supervisory capacity framework, not just within the RBI but outside in the parallel agency as well, stronger. And unless we do that, I don't think we should jump ahead to trying to take these very, very big risks.
Mhm. Mhm. Uh, Robin Bhaumik, again, a suggestion kind of a question, or is there value in getting the new corporate banks to focus on just funding infrastructure? Retail banking services can be also delivered by neo banks. So why take a banking license at all?
So, when some of these specific banks were tried, like remember the payment bank, where you tried to say that banks should only do business X, where we
Yeah.
decide what the business model of the bank should be, where the regulator, instead of saying that I'll build the regulatory capacity to supervise or I'll be able to supervise you, says that you do business model X. Now, why did that, other than a few payment bank licenses, and that too, telcos and a couple of others, the payment bank license model, which I think 17 banks, initially there were 17 or such number of bank licenses, payment bank licenses that were taken, many withdrew, they were not profitable. So what happens is that when you are trying to tell somebody how to run your business, that is, you will lend only to infra or you will lend only to this, those sort of models don't particularly work very well, because they may not either be able to make profits, or the risks may be too high. Now remember, some of the earlier entities like ICICI, there used to be these entities in India that were meant for lending for infrastructure,
Right.
and most of them had to be built out, because the suppose you've lent to three large infrastructure projects and one goes bankrupt, your balance sheet gets completely wiped out, your equity gets completely wiped out. So just lending to infrastructure may actually not be a very good business model.
Mhm.
So I don't think that we should be telling, or the regulator should be putting down what the business model of the bank should be. The bank can choose, once it gets a license, it can diversify its risk across various sectors, across various businesses, partly retail, partly infrastructure, according to how it sees its risk and reward.
We are running out of time. We have a couple more questions, and I'll take two last questions. B.S. Kumar says, on the one hand, the government is merging government banks to say to limit them to 8 or 10, 12 banks. And on the other hand, you're preventing new players from entering. Uh, isn't that counterintuitive, contradictory?
So again, it should give more bank licenses. Absolutely. In fact, it's been discussing giving, RBI has been discussing giving bank licenses on tap, and it has, given very, very few. Two, I think, in the last decade or something. So very, very few bank licenses have been given, maybe more. For the smaller banks, a few more licenses have been given. But I think the debate also needs to go into fit and proper. So, who should you give licenses to? And that is where today's debate is, that it is bank licenses for corporates. And do you think that there is less risk in giving to corporates or not? Not that licenses should not be given.
Mayank Paneri has a suggestion. Since public deposits up to rupees 5 lakh are insured in bank accounts, would there be a problem if, say, corporate bank deposits are capped at 5 lakh rupees limit?
So, if let's just play a thought experiment that you did do that, and the Deposit Insurance Corporation of India would then have to, which is the institution that insures these deposits, would then have to step in and pay out 5 lakh rupees if the bank failed. Should that institution have the powers to supervise the books of the bank before it goes bankrupt? My answer to that would be yes. So if today also you want to go ahead and do that, okay, instead of jumping to whether it should be a corporate who owns it or not, I would say that the FRDI proposal of setting up a resolution authority which has supervisory capacity should mean that even for a 5 lakh deposit insurance, you need to give it the powers to supervise the books of that bank, because it is the institution that has to bail out these banks. So let's do that first, and let's not jump to giving licenses to corporates and capping those. For every one rule where we are doing something wrong, we don't want to make 10 more rules, which tomorrow 5 lakh will be an amount that will be too low. Tomorrow you'll be, every time I get interest into my bank over 5 lakh, I have to go and withdraw that money to keep it capped at 5 lakh. So let's not create more complications uh, before we start giving out more licenses.
Licenses. Thank you, Ila. I think we have absolutely run out of time. And my apologies to Kiran Sachdeva and Sundareshan. Your questions have already been answered by Ila earlier during our discussion. So please do go back to our video from the beginning and you will get answers to what you have asked. We will be back next week with another new episode, live episode of Ilanomics. So thank you very much for watching us. And please do come back next week and do tell your friends and family about our show so that they